A very warm welcome to all of you to one more presentation of knowledge series on GST. Today we will be discussing about value of supply. In this presentation, our approach will be to understand the proposed law in an objective manner. Before we go into today's topic, let us find out what is a taxable event. As on date, excise duty is applicable on manufacturing, service tax is applicable on rendering of services, and VAT is applicable on sale of goods, which largely involves transfer of property in goods. But under GST, supply is a taxable event. Liability to GST will be on supply. It has been defined under Section 3 of Draft CGST Act 2016 to mean and include not only goods and services for consideration, but also supplies without consideration, imports, supplies between agents and principal, branded services provided by aggregators, etc. This liability to pay will arise at the time of supply as provided under sections 12, 13 and 14. This topic is discussed in my presentation on time of supply. Amount of tax we are required to pay depends upon the value of supply. In the following few minutes, we will talk about the definition under section 15 subsection 1 and read it along with subsections 2 and 3. We will then find out the circumstances for resorting to valuation rules and go through these rules one by one. Let us begin at the beginning. Subsection 1 of section 15 defines value. It says that value should be transaction value, that is the price actually paid or payable for the said supply of goods or services, if the following conditions are satisfied. Firstly, supplier and the recipient are not related, and secondly, price is the sole consideration. These concepts are in line with existing excise laws but new to the VAT laws. If we are not able to fulfill these conditions, then under subsection 4 of section 15, valuation will be done as per valuation rules, which we will discuss little later. In order to find out whether we satisfy these conditions, we have to understand the meaning of related person and consideration. Subsection 82 of section 2 defines related persons. This section is similar to subsection G of section 2 of Customs Valuation Rules 2007. Related persons are defined to mean 1. Common directors or officers, 2. Partners in a business, 3. An employer and his employee, 4. Any person directly or indirectly owns, controls or holds 5% or more of the outstanding voting stock or shares of both of them. So, you can see that even if an investor innocently owns more than 5% shares in two companies, he will make them related. 5. One of them directly or indirectly controls the other. 6. Both of them are directly or indirectly controlled by a third person. 7. Together, they directly or indirectly control a third person. Please note that indirect control has not been defined. 8. They are members of the same family. Again, family has not been defined in the Act. That is not all. We have two explanations which are appended. 1. Persons include legal persons. 2. A person associated in the business of another as sole agent, etc., however described, shall be deemed to be related. These concepts are also very new for VAT laws. Even excise or income tax laws do not have so wide definition of related persons. Such a wide definition for each and every transaction may be difficult for business enterprises. Let us now come to consideration, which is defined under subsection 28 of section 2. It is an inclusive definition. It covers two types of transactions in relation to the supply of goods or services to any person. First one is any payment made or to be made, whether in money or otherwise. So non-monetary payments are also included. And the second one is monetary value of any act or forbearance, whether or not voluntary. In both these cases, the transaction should be in respect of, in response to, or for the inducement of the supply of goods or services, whether by the said person or by any other. It has been further provided that deposits, whether refundable or not, are not treated as payment unless the same is applied by supplier as consideration for the supply. Words like inducement given in the definition is new to our tax laws because this definition is copied from subsection 1 of section 2 of GST Act 2014 of Malaysia. Let us have a quick look at the definition of value under the existing laws so that we can understand that the concept of value under GST is much wider. Section 4 of Central Excise Act states that excise duty is payable on the transaction value if the goods are sold at the factory gate to an unrelated buyer and when the price is the sole consideration. Section 14 of the Customs Act 1962 states that the value of the imported goods and exported goods shall be the transaction value of such goods. That is to say, the price actually paid or payable for the goods when sold for export to India for delivery at the time and place of importation, or, as the case may be, for export from India for delivery at the time and place of exportation, and where the buyer and seller of the goods are not related and price is sole consideration. Subsection 2 of Section 15 specifies that transaction value as determined by subsection 1 shall include certain amounts. Let us discuss them one by one. Amount incurred by the recipient on behalf of the supplier. To take an example, M is deputed by S to R for doing data entry for Rs 10,000 a week. S requests R to pay Rs 7,500 directly to M and bills him only for Rs 2,500. Under provisions of subsection 2 of section 15, Rs 7,500 will be added to the transaction value. Goods or services supplied free of charge by recipient. This is in line with the current valuation principles prescribed under the indirect tax laws. Example, R supplies 1,000 bags of cement to S for constructing his house. The value of the cement has to be added by S in transaction value. Royalty and license fee. This is in line with the present valuation principles under excise and customs law. This provision would avoid present system of dual taxation in some states. Example, S supplies minerals to R. Royalty payable to government on mining has to be included by S in the transaction value. Taxes, duties, fees or charges except GST. This principle is adopted from the state VAT laws. First of all, this definition does not include the words connected to supply. So, will it also include fees like, say, MCA fee, pollution control fee, local body license fee, etc.? In its present form, the inclusion is too wide. Taxes are not value additions, hence the provision should be revisited because it is against the principles of GST. Pre-supply expenses like commission and packing. Any such expenses, including any amount charged to recipient for anything done by the supplier in respect of supply at the time or before delivery, is to be included. Example, S supplies 100 quintal of rice to R at the request of R. S puts them in gunny bags of 50 kgs before sending the goods and charges Rs 1,000. Rs 1,000 has to be included in the transaction value. Subsidies. All subsidies are to be included. Example, Mr. Z wants Mr. Y to give a musical performance. As he cannot afford to pay the usual charge of Rs 1 lakh, he requests Mr. A to pay Rs 40,000 directly to Mr. Y. The transaction value for Mr. Y for raising his bill will still be Rs 1 lakh. Expenses reimbursed. Reimbursement expenses or cost incurred by or on behalf of the supplier in relation to supply are to be included in transaction value. Here, the primary liability to pay GST is on the supplier. Example, A claims taxi charges from B for doing audit. A has to add the taxi charges to the transaction value. Further reimbursement towards expenditure in relation to supply of services is not includable in transaction value if the same are incurred in the capacity of pure agent, as the primary liability to pay GST is on the recipient. This is detailed in Rule 8 of the valuation rules, which we will discuss in a short while. Any post-supply discount offered are to be included. However, we can exclude discounts which are established as per an agreement and known at the time of supply and can be linked to specific invoices. Also, subsection 3 provides that discounts which are allowed before or at the time of supply in the course of normal trade practice and has been recorded in the invoice would not form part of the transaction value. But one major concern is that many times post-supply discounts are market driven. Depending upon the demand of the product in the market additional post-supply discounts might have to be offered to clear the stock or gain back lost market share. In such cases, this provision will be harsh on the trade. We have now gone through the valuation of supply as provided under Section 15, subsections 1, 2 and 3. Now let us find out the circumstances under which we have to resort to the valuation rules. Subsection 4 to Section 15 lists 5 such circumstances as the value cannot be determined under subsection 1 of Section 15. They are: firstly, the consideration is not money wholly or partly. Wholly, for example, exchange of old newspaper for steel vessels. Partly, for example, exchange of old television with new television. Secondly, the supplier and the recipient are related, even if the price is sole consideration or at arm's length, subject to Rule 3, Sub-Rule 4. Thirdly, there is reason to doubt the truth or accuracy of transaction value declared by the supplier. In such cases, the procedure to be followed is detailed in Rule 7, which we will go through shortly. Fourthly, business transactions undertaken by pure agents covered under Sub-Rule 1 of Rule 8, money changers covered under Sub-Rule 2 of Rule 8, insurer, air travel agents, and distributor or selling agent of lottery. Lastly, other notified supplies on recommendation of the GST Council. Before we go through the details of the rules, let us have a quick comparison of the proposed rules with the existing regime. Under excise, MRP-based valuation in certain cases and transaction value in remaining. Under VAT and service tax, no specific principles except specific inclusions and exclusions. Under GST regime, no concept of MRP or RSP, it is transaction value, sequential determination by comparison method, computed value method, and residual method, rejection of declared value, separate valuation in case of pure agent, money changers, etc. We will now discuss the provisions of GST, valuation, determination of the value of supply of goods and services rules 2016. These rules have been largely borrowed from existing single point levies for GST, which has a multi-point levy. Rule 3 of these rules provide us the general rules of valuation. 1. Subject to Rule 7, value of goods or services shall be the transaction value. 2. Transaction value shall be the value determined in monetary terms. 3. Where supply consists of both taxable and non-taxable supply, the taxable supply shall be deemed to be for such part of the monetary consideration as is attributable thereto. 4. Transaction value shall be accepted even between related persons, provided the relationship has not influenced the price. So, even though I am not able to adopt the transaction value under subsection 1 of section 15, I have a chance to prove under this rule that relationship has not influenced the price. 5. Transaction value shall be the value of such supply where goods are transferred from A. one place of business to another, B. the principal to an agent or vice versa, whether or not situated in the same state. 6. Where valuation is required under subsection 4 of section 15, we have to proceed sequentially from Rule 4 to Rule 6. Now, let us discuss the mechanism and procedure of rejection of declared value under Rule 7. When the proper officer has reason to doubt the truth or accuracy of the value declared, he may ask the supplier to furnish further information including documents or other evidence, and if after receiving such further information or in the absence of any response from such supplier, the proper officer still has reasonable doubt, it shall be deemed that value of such goods and or services cannot be determined under Sub-Rule 1 of Rule 3. In an inclusive definition, 3 reasons to doubt the truth or accuracy of the value has been given. They are: firstly, significantly higher value at which goods and or services of like kind or quality supplied at or about the same time in comparable quantities in a comparable commercial transactions were assessed. Secondly, significantly lower or higher value of the supply of goods and or services compared to the market value of goods and or services of like kind and quality at the time of supply, or lastly, any misdeclaration of goods and or services in parameters such as description, quantity, quality, year of manufacture or production. The proper officer shall intimate the supplier in writing the grounds for doubting the truth or accuracy of the value declared in relation to the supply of goods and or services by such supplier, and provide a reasonable opportunity of being heard before taking a final decision. After hearing the supplier, if the proper officer is not satisfied with the value declared, he shall proceed to determine the value in accordance with the provisions of Rule 4 to 6, proceeding sequentially. This provision seems to be providing officers with unduly huge powers for rejecting the valuation. Rejection of value much after the transaction is over will lead to uncertainty and financial loss to the supplier. As you have noticed, all roads deviating from subsection 1 of section 15 leads to valuation methods under Rule 4 to 6, and one road leads to Rule 8. So, let us go through these rules one by one. Rule 4. Determination of value of supply by comparison. Value to be determined on the basis of transaction value of goods and or services of like kind and quality supplied at or about the same time to other customers. After reasonable adjustment by the proper officer for difference in the date of supply, commercial levels and quantity levels, composition, quality and design between the goods and or services being valued with which they are compared, freight and insurance charges depending on the place of supply. It is respectfully submitted that such comparison will be highly subjective and left to the discretion of the officers. To understand the valuation more fully, let us have a look at some of the definitions. Subsection 67 of section 2 defines that market value shall mean the full amount which a recipient of a supply is required to pay in order to obtain the goods and or services of like kind and quality at or about the same time and at the same commercial level, where the recipient and suppliers are not related. Subsection 68 of section 2 defines that money means Indian legal tender or any foreign currency, check, promissory note, bill of exchange, letter of credit, draft, pay order, traveler's check, money order, postal or electronic remittance, or any such similar instrument when used as consideration to settle an obligation or exchange with Indian legal tender of another denomination, but shall not include any currency that is held for numismatic value. Like kind and quality are defined under Sub-Rule 1 of Rule 2 separately for goods and services. Under Sub-Rule 1b, goods of the like kind and quality means goods which are identical or similar in physical characteristics, quality and reputation as the goods being valued, and perform the same functions or commercially interchangeable with the goods being valued. And under Sub-Rule 1c, services of the like kind and quality means services which are identical or similar in nature, quality and reputation as the services being valued. In both cases, supply may be made by the same person or by some different person. These rules have been taken from the existing customs law. In cases of goods, it may be possible to compare like this, but in case of supply of services, no two service provider can provide the same quality of service, especially in case of professional services. The second method is given under Rule 5, which is computed value method. Computed value method should include cost of production, manufacture or processing of the goods, or the cost of provision of the services, charges for the design or brand, profit and general expenses equal to that usually reflected in the supply of goods and or services of the same class or kind as the goods and or services being valued, which are made by other suppliers. Rule 6 is the residual method. Under Rule 6, if the above two methods fail, then residual method has to be adopted, which is to compute value using reasonable means consistent with the principles and general provisions of these rules. Now, let us proceed to study Rule. Sub-Rule 1 of Rule 8 lays down the rules for valuations of transactions of a service provider who acts as a pure agent of the recipient. It is provided that expenditure or costs incurred by such service provider shall be excluded if the service provider acts as a pure agent of the recipient while making payments to third party, payment made by the service provider on behalf of the recipient of service has been separately indicated in the invoice issued by the service provider, Service provider recovers only such amount as has been paid by him, and these goods and or services procured by the service provider from the third party are in addition to the services he provides on his own account. Whereas, recipient of service is required to receive and use such goods and or services, be liable to make payment to the third parties, authorize the service provider to make payment on his behalf, know that the goods services shall be provided by the third party. These rules are based on the existing service tax valuation rules. Subrule 2 of Rule 8 provides for valuation of transactions of money changer. Two situations have been envisaged in the rules. The first situation is when currency is exchanged from or to Indian rupees. In such cases, value of taxable service shall be equal to the difference in buying rate or the selling rate, as the case may be, at the RBI reference rate for that currency at that time multiplied by total units of currency, or 1% of the gross amount of INR provided or received if RBI reference rate for a currency is not available. In the second situation, when neither of the currencies exchanged is INR, the value shall be equal to 1% of the lesser of the two amounts the person changing the money would have received by converting any of the two currencies into INR on that day at the reference rate provided by RBI. Your suggestions. What we have been discussing in this video is not yet the law of the land. In order to engage with the stakeholders, Government has made available the draft model laws on GST in the public domain on 14th June 2016. The link is available in www.mygov.in. Do provide your suggestions and comments on the model GST law to the government. Your suggestions will go a long way in making the law vibrant, taxpayer-friendly, easy to administer, and free of litigations. Now, let us go through some of the suggestions made by the Institute of Chartered Accountants of India on this topic to the government. There is an apparent conflict between the wording of subsection 1 and 4 of section 15. Certain cases covered by subsection 1 may also need to be examined by rules. Hence, subsection 4 needs to override subsection 1 but be made applicable in the cases specified. The words notwithstanding anything in subsection 1 may be added at the beginning of subsection 4. To ensure that there is no ambiguity, it has been suggested that the words for the purpose of this act and notwithstanding anything contrary to any other law for the time being in force be added before the words value of a supply, so as to enable application of section 15 to CGST, SGST and IGST. A proviso be added to state that the transaction value shall be determined in accordance with the GST valuation rules. Rule 7 of the valuation rules provides as an inclusive list of the reasons to doubt the truth or accuracy of the value of the supply declared by the supplier to the proper officer. As the reason to doubt the truth and accuracy are not limited to the list provided, the provision puts an arbitrary power in the hands of proper officer which may prove draconian and work against the assessee. It is suggested that an exhaustive list of the reasons to doubt the truth or accuracy of the value of the supply declared by the supplier be provided to the proper officer in place of an inclusive list to negate the possible ambiguities. Subrule 1 of Rule 3 of the valuation rules does not specify that the transaction value so determined is for the purpose of section 15. It is suggested that Rule 3(1) be redrafted as, for the purposes of section 15, value of goods and or services shall, subject to Rule 7, be the transaction value. As per Rule 3(5), GST valuation rules, where goods are transferred from one place of business to another place of the same business, the value of such supply shall be the transaction value. Taxing such supplies will cause lot of financial hardship. Capital goods like machines, cranes, etc. require huge capital deployment, and levy of tax when they are moved for business purposes will prove to be a huge financial burden for the entities. The supply of capital goods, whether to own depot or to the customer, be kept outside the purview of GST. Also, movement of capital goods for provision of services like renting, leasing, transfer of right to use be excluded from the scope of supply under the proposed GST. Schedule 1 details supplies without consideration. it is suggested that the valuation mechanism be provided for valuing the transactions covered under Schedule 1. Clause D of subsection 82 of Section 2 of the Model GST law provides that persons shall be deemed to be related persons if only any person directly or indirectly owns, controls or holds 5% or more of the outstanding voting stock or shares of both of them. In the Income Tax Act 1961, substantial interest is quantified by a 20% interest, control or management. In the Companies Act 2013, 20% interest is essential to become an associated enterprise. In alignment with other laws, a similar limit of 20% should meet with the purpose and intent of this statute. It is suggested that percentage of direct or indirect control or holding of the outstanding voting stock of shares of both of them be increased from 5% to 20%. Do help in spreading this video to all and subscribe to the channel. Your comments for improving the content is most welcome. Thank you very much.